What's happening, everybody? Welcome to Risky Ryan Trades. Today we're going to be going over ETFs, compounding interest, and a couple bar charts to outline the difference between different investments. Right off the bat, disclaimer, this is not financial advice. Do not follow me. If you choose to do what I do and act on the information in this video and you lose all your money, well, hey, you can't sue me, okay? However, the information that I'm going to be outlining today is what I use to navigate my investing strategies. So let's dive right into it. First off, I'm 34 years old. I'm interested in growing my account. I got 30 years until I retire. I'm not trying to YOLO and get rich tomorrow. I'm in it for the long run, but I'm also fine with decent swings up and down because I'm not going to be touching this money for decades. So I want to give it time to compound and outperform the market. And what is the market? Often when you hear people talking about outperforming the market, they're talking about the S&P 500. Which is this right here. So I did a little study here. Over the last 20 years, the S&P 500 has returned approximately an average annual rate of 7.7%. And if the dividends are reinvested, which I would suggest doing if you go that route, that's what I would do, you would get a 9.8% return. And this is the 500 biggest companies, most profitable companies in America. The QQQ Trust, this is the Nasdaq, maybe you heard of it. It's based on 100 companies. It's a little bit more weighted towards tech. And in the last 20 years, you've got an average of, call it 14.5%. So what does that look like if you were to invest? Now, we're going to do quick studies here. Let's say you're a kid, 18 years old, just graduated high school. Let's say that you're going to put it all in the S&P 500 and you can only afford to put in $100 a month for the rest of your life. And you don't have any money in your account. And by the way, this is a Roth IRA calculator. A Roth IRA you can open up, contribute at the time of this video, $7,000 per year maximum. And when you take the money out, you don't have any taxes. So it's the money's pre or post-tax that you put in, and then you don't get taxed when you pull it out. Okay, let's click calculate. So look at that. Just set it and forget it. $100 a month, starting at 18 for the rest of your life, you'll have $1 million. Not bad. Now, what if you were to put it in the Nasdaq and you were to get that 14.5%? We'll call it $8 million. Look at the difference. Like, wow. Now, let's say that you're an 18-year-old and you actually have some money. You're probably in a rare case, but let's say you maxed out the contribution, $7,000 per year. $28 million by retirement. Incredible. Okay, now who's going to do that? Probably nobody. So let's take a look. Let's say you're 25. Say you're 25, and let's say that you don't have anything in there. Let's say that you can contribute $200, and you're doing 9.8%. You'll have $1 million. Let's say you put it in the Nasdaq, 14.5%, $3.7 million. Now, what if you maxed it out? $10.8 million. All right. Now, if you're like me and you're 34, you're a little older, let's call it 35. Okay, 9.8. Now, I'm going to suggest maxing it out, okay? Because look at this. Only $1 million. You're going to have to max it out starting at 35 years old to hit that $1 million. Now, if you have a little bit more risk appetite like I do, and you put it in the Nasdaq, 14.5, 2.8 million. Now we're talking. Okay, so let's take a look at these bar charts. So this ticker right here at the bottom, that's the S&P 500. And I've got some ETFs that I personally invest in drawn out right here, and this is based on 10 years. Okay, the blue one in the middle, that is the Nasdaq QQQ. The orange one, which I also like, is the Schwab High Growth. And the purple one on top, that is the Vanguard Technology Fund. And you can see it has a pretty decent outperformance. All of these have pretty low management fees. And by the way, the QQQ, the ETF that I use is QQQM. QQQM is only 3 years old, so it wouldn't show up on this chart, but it has significantly lower management fees. So those management fees, I'm not going to get into it in this video, but they can eat your profits alive over the course of 10, 20, 30 years. We're talking hundreds of thousands of dollars you're leaving on the table paying someone. Okay, now what if, now notice how when it goes up, but when it comes down really bad. What if we were to invest at the worst possible time, right at the top? Right at the top. Look at that. Within 2 years, you're caught back up, and now you're going back to outperformance. So even if you invest, you know, and we can look at this more granularly here. So here, I'm going to put it at a 5-year. Now, as I drag this along, you can see there's certain times where you'll be underperforming with these indexes, the S&P 500, and outperforming. Like, if you invested right here, you would spend a decent amount of time underneath. But as long as you can hold on for a little bit longer, look at that. Now it starts to get back above, and you start outperforming. And if you had invested in November at the bottom, you'd be doing pretty well. And remember, the difference between the S&P 500 and the QQQs was what, 5% per year? This isn't even a year span, and you're already, for the SCHG, which I like, you're already up, what is that, 7%? 8%? So these things make a very, very large difference. I love these ETFs. They're great for getting diversification, simplifying everything. However, I want you to see what individual stocks, certain individual stocks, what they look like on here. Now, the number one holding of the S&P 500 and all of these ETFs is Microsoft. Maybe one of them has Apple as number one, but we're just going to put Microsoft on here real quick. Microsoft will be in green. Okay, over the last 5 years, it's pretty much in line with all that. But if I back it up, all of a sudden, holy crap. Yeah, if you had invested in Microsoft in 2015, which, you know, for instance, my dad felt like he missed the boat on Microsoft 10 years before 2015. If he had just said, well, maybe Microsoft still has some legs and invested there, look at the difference between investing in the S&P 500 and Microsoft. I mean, it's huge. Let's take a look at Apple. Actually, no. We're going to take a look at Costco. Costco absolutely crushes it. And Costco is in the deep blue. So in the last, here, let's just click 3 years. Last 3 years, look at that. Beautiful, beautiful, beautiful. 10 years, it's beating all of those other indexes. There are certain strong stocks. Let's put Apple on here. Yeah, right up there. So, yeah, you guys, certain individual stocks are worth putting some money into. And the way I like to look at it is I see, like, okay, Nasdaq, S&P 500, Schwab High Growth, VGT, this technology thing, they're all pretty overweight Microsoft, Apple, Amazon, NVIDIA, like these big mega cap names, they're pretty overweight on them, and that's how they're getting this performance. So, you know, me personally, I like to invest in these ETFs as sort of like my, you know, my steady, like, foundation, and then I like to add a little bit extra. And you know, VGT, I think 11% of their portfolio in VGT is Microsoft. So And then, on the S&P 500, it's only about 6%. For the Qs, it's more like 8%. So having a little extra weighting on the top held positions in these ETFs, if you like the business, not a bad idea, in my opinion. Now, the problem is, let's take a look at 2022. Actually, here, I wonder if I can. So, they're not always going to be blowing everything away here. Let me see if I can. All right, I'm going to back it up. So, look at this. Right now, Apple, if you invested Apple in July of 23, right now, you would have been better off investing in the S&P 500. However, you give it enough time, and it catches up. Look at it right now, just like the last 6 months. It's way overperforming. So you're going to have this in and out. But what I noticed with some of these big names, and there's some other ones, like these ones are, most of their growth is behind them, perhaps, anyways. But let's, I'm going to add one that I really like onto here, CrowdStrike. And let's look at a 2-year chart. So look at this. Big time gains. Let's bring it back. Okay, so this would have been rough to go through this, wouldn't it? But if you dollar cost average, and you buy, and let's say that your average comes out to right here. Ooh. Once you get over, here, let me back it up more, because this chart gets more impressive. Okay, look at that. CrowdStrike. What a beast. Now, in my opinion, cybersecurity is a fastly growing technology field or sector. It's not, this company, CrowdStrike, is not going bankrupt. They're the fastest growing, becoming top dog cybersecurity company in America. It has a high beta, which means if you had bought right here, you would have watched you would lose half your money temporarily. I'm a big believer in cybersecurity. I think that if you can ride this rodeo, you are going to be solid. Let's just look at NVIDIA, just to make everybody look small. Absolutely insane. So this is the power of compound growth. My approach to this, to outperform these indexes, is I like to have a little bit of these indexes in my portfolio just to ensure that some of it doesn't go up in smoke and outperforms. But I can't help but notice that the major holdings in these indexes are the reason why these indexes perform really well. And if you have a little bit extra of them, say I like Microsoft, but I don't like Google that much. Okay, well then I won't add extra Google, but at least if I have these ETFs, I will have some Google exposure, some Meta exposure. You almost can't afford not to have exposure to some of these companies, because at the end of the day, like NVIDIA, for instance, you might think that, oh God, NVIDIA is just too risky. Well, guess what? NVIDIA, at the moment of this video, has the market around the neck. I mean, if NVIDIA crashes, everything crashes. So you have NVIDIA exposure if you're in the stock market, whether you like it or not. So having a little extra. Oh, you know what? Another one I like. I almost forgot. If you watched this far into the video, this is your reward. SMH, semiconductors. So that includes NVIDIA. And SMH is in green. Look at this. Less beta than NVIDIA. It's a little bit smoother. You're a little bit more diversified. But the growth is absolutely insane. So there you have it. Those are my, ideas and how I look at my portfolio. Some ETF ideas. And these are better than mutual funds. They cost less. You can trade them in and out. There's no trading fees really. So for depending on your broker. Yeah. So anyways, I hope you found this helpful. I hope you learned something. If you did, could you please smash that like button, comment, send it to your friends, give me some video ideas. I'd love to, see your questions, get a conversation going, all that good stuff. So Risky Ryan out, and I'll see you on the next one.